Hello, everybody, and welcome to another podcast in our series. Myself, Ken Dahl, financial planner, along with Jaryd Runquist, who's an accountant in Saskatoon, and we like to collaborate on these videos and just share information that is hopefully of value to whoever's listening. So thanks for joining us. If you are listening today, I really appreciate it. Today, we're going to talk about something called the CDA, which is otherwise known as the capital dividend account. As a financial planner and as an a life insurance person, I know that the CDA is a large part of a way that people can get money out of their corporation, essentially tax free. So let's kind of dive into that. So my layperson understanding of the capital dividend account is that if you do have a life insurance policy in your corporation and the key person is to pass away, that insurance policy pays into the um, pays into the corporation, and then whatever from that policy, whatever is in the corporation, can then flow out through the capital dividend account to the deceased spouse that way. So the capital dividend account really is a way of flowing money out of a corporation tax free. So there are some nuances involved, but when you do that, what flows out of the capital dividend account is the amount of the life insurance policy that's over its adjusted cost base, or ACB. Usually ACB, it differs for all policies, so don't quote me on this, but it's usually around 20%. So that would mean 80% of that policy's payout could flow out to the deceased's spouse. So that's something I just wanted to get out there. A lot of business owners that I talk to are not familiar with that, or not aware of that. And it's just a great benefit, because one of the first questions that business owners always ask is, how can I get money out of my company tax free or with as little tax as possible? So that's it. Jaryd, feel free to jump in and add your non-layman accounting expertise to this.
No, that's a great high level summary.
Very high.
And you know what? At the end of the day, I think that's the most important thing when talking about CDA and the complexities of CDAs, that really, from a conceptual standpoint, whenever a death benefit is paid into a corporation in Canada, meaning you have a life insurance policy, there's an insured that passes away, unfortunately. Those proceeds get received into the beneficiary, being the corporation, ideally the policy owner. They're going to get a credit against the CDA account. That could be 100% of the death benefit. For conceptual reasons, a lot of advisors will just say that the death benefit credits the CDA, right? Because it is a complex topic. But a lot of the time, there can be a bit of an erosion on that amount. So if we have, let's say, a $10 million death benefit, and the ACB is $1 million inside that policy, then you're only going to get a CDA credit for that $9 million. So if you want to extract the full 10 million out of the company to maybe redeem your shares out of the estate, then you're going to have to pay $1 million of tax on that dividend. Well, a tax on that $1 million dividend that will be coming out of the corporation, because you only received 9 million of the 10 million that was technically tax free. And I won't get into the stop loss carryback rules here with CDA redemption or share redemptions here. That's for the very deep depths of the weeds here for estate planning. But conceptually, I think it's important, Ken, to just keep it simple, right? How does insurance compare to other investments, right? I mean, that's really what it comes down to when you're analyzing insurance is, well, what's the next best alternative, right? And I think that's the aim of our videos is, how does it line up against it doing it a different way? And this is a key component of insurance and estate planning. I often joke that if the government gets rid of the CDA as treatment with insurance policies, I might be out of a job. So it's a very attractive tool, and it separates itself from essentially every other asset class in terms of tax treatment. If you look at, selling an investment property, if you have that same $10 million gain inside the corporation, you'll get a 50% amount of that $10 million gain treated as CDA. And then let's say you got the house for the investment property for $0. So the total gain is 0 to 10 million. It's a $10 million gain. 5 million of that will credit your CDA. Now the remaining 5 million will actually be exposed to passive income tax rates. So in Saskatchewan, it'll be just over 50%.
Yep,
Right.
and just
And
under 50% here in Alberta, so
yeah, you've got a bit of a bit better treatment than we do, but
not much,
still
but a little
still
bit.
not great, right? So
Yeah,
that's going to credit your refundable dividend tax. And then you, for that 5 million, if you want to extract that out of the company, you're going to have to pay another, you know, uh, or take out the full 10 million. You're going to elect to use 5 million of that CEA to shelter that. So you're not paying any dividend tax on that amount. And then the remaining 5 million on that gain in the investment property, you'll actually have to elect to likely have an ineligible dividend that's paid out, and you'll
right.
recapture some of that refundable dividend tax. But that ineligible dividend, you'll be paying, 40, forty-one
40
percent of tax on
40%,
it.
yeah, yeah,
Yeah. So it's, thinking about insurance and how it's treated versus other asset or other investment property. It's very efficient from a tax perspective, and I think that's the important thing. And I know in our previous video we talked about, okay, well, you want to look at insurance on a pre-tax basis, right? Because really most of it will be getting received tax free to the estate. So then you have to look at it, okay, well, if it's getting 5% to the estate from an investment standpoint inside the corporation, well, you have to mark it up for those taxes to see what it would have to earn on a pre-tax basis inside the corporation. And I'm saying tax a lot. It's probably, it might be losing some people in terms of all the jargon, and I apologize for that. But it's very important to look at it apples to apples, and that's an important feature of insurance where, hey, all of it can be, well, most of it in some cases will be funneled out through that CDA. So you're preserving all of that capital to the estate.
right. And it's as you said, Jared, thanks for that explanation. As you said, it's a great tool. And, my point or our point is just that it's not very well known. And I just want to make business owners aware of it because I deal with a lot of people that are retiring and they have corporations and they have, significant retained earnings in that corporation. And they're just not sure how to, they're going to dividend some of that out to help fund retirement, but there's probably still going to have money left at the end. So, having that corporation purchase the policy, first of all, the policy has tax sheltering benefits while you're alive, so that's a number one bonus or benefit, and of course, the insurance pays tax free upon death. So that's number two. There's no tax there, so you're really churning taxable money that's inside, even if it's still inside the corporation. You're turning it from a taxable investment to a different investment vehicle, which is the insurance policy, um, which offers tax sheltering that your normal retained earnings do not have. So it's just a really good tool, but people don't realize again, and the point is just that if you have retained earnings in your corporation, you're not likely going to use. It's just a great way uh, to 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 protect that money that's in the corporation, and also to do that insurance policy, and then to flow money out to your generally it's to your spouse through the capital dividend account. And that's just a great thing. And like you said, with if CRA ever gets rid of the capital dividend account, well, that's not a good thing, obviously. So we want to take advantage of it as much as possible. But I'm not saying that that's on the plate for them to take it away. But if they did, that would be a tough blow. But anyway, it's just a
It would.
really really good benefit that's not being used. Is kind of my my message for today, or our message, is just, consider that. And as Jared's an accountant, so he kind of went into the weeds a little bit. But if somebody's going to do a life insurance policy inside their corporation, the insurance agent is obviously going to be talking with the client and the client's accountant. And if that's Jared, then Jared will talk to the client's accountant, and they can work out the RDTOH and all that kind of stuff. But just to make sure that it's well set up for that particular situation. But again, it's just again, one of the your first questions I get from business owners: how to get money out of my corporation tax free or with a little tax. Well, there you go, the capital dividend
How do I
account.
pay zero tax?
Yeah,
Yeah.
how do I pay zero tax? Life insurance policy in the corporation. And like I said, it's like a TFSA in the corporation. As long as you've got money in
Mhm.
that policy in the corporation, it's
Well
tax
said.
sheltered. So these are great benefits that CRA affords us, and we just want to use them and make people aware of them, because I mean, it can save on a $10 million corporation. You could save $2 million in tax, and or more, and that's enough to get my attention. That's for sure.
I think it's important to note too, just talking about how insurance is structured as well. In most cases, Ken, you're going to have for these, estate planning policies, they're going to be larger insurance policies in most cases. A lot of them will be structured over a 10 pay period, meaning you're going to pay the premiums for 10 years. A lot of the cases, they're going to be overfunded to the max amount because that's just going to increase the overall rate of return of the policy long term. And then after the 10th year, you're going to turn off the premiums. And that's usually how insurance is usually pitched, because 10 years is just an easy it's a easy number to understand. And then you can, you're not committed to premiums for life, and you can still get that growth trajectory that's really optimized for your situation. The one thing that I should mention is typically if you're paying premiums and then you're stopping in the 11th year, that 10-year mark is very likely going to be the peak for your ACB, because ACB feeds into the CDA calculation. So that means if your ACB is highest at that period, your CDA will probably be at its lowest point then. And I don't like to deal in absolutes, so I'm saying in most cases that's the scenario. Uh, but more often than not, during that 10 pay period, your CDA is going to be the lowest then. And the reason why is because your death benefit will continue to grow, but during that 10-year period, you're paying the premiums, which increases the ACB. So if we think about the formula that they use to determine CDA, it's CDA is equal to the death benefit minus the adjusted cost basis, or the ACB of the policy. So if your ACB is peaking at that 10th year, well, then that CDA credit in theory should be at its smallest point. And then once you're done paying those premiums, if you don't turn them back on, that ACB will slowly start to erode, and it'll start to decline over time. So your death benefit will continue to rise, and your ACB will actually continue to grow, or to decrease,
Decline. Yeah.
which maximizes that CDA
Right.
amount. And before life expectancy, which, we can just say a rough ballpark of 85 years old for both males and females in Canada, even though it's a bit different than that, but just for example, it's the ACB will ground down to zero before that point. So by life expectancy, in theory, the CDA will equal the death benefit amount, depending on how the structure is, or how the policy is structured. Obviously, we're not dealing in absolutes here, but more often than not, your CDA credit will actually equal the death benefit. Meaning, if we're setting aside stop loss carryback rules here, that you can get the money out 100% tax free from the company if you choose to do so in the year of death. So that's really powerful for business owners in
That
Canada.
that's Thanks for that explanation. That is very powerful. And by using the 10 pay, as you say, after the 10-year period, you're not paying any more premiums, but the value of the policy is increasing and the ACB is being ground down over time. So at a normal life expectancy, by the time that person actually does pass away, the ACB is could be 0 or 100% of that death benefit can be paid out tax free. If there's a premature death in terms of not quite living to life expectancy, it'll be a little bit less, but it's still very, very beneficial.
Yeah.
So, I mean, that's just, it helps you. It helps you while you're alive. It helps you upon passing. It helps you from estate planning purposes. It helps you with your corporation windup. And it's just, just a really cool tool, which is why I wanted to talk to Jared about it today and get the accounting's perspective. But
And it also
man,
helps with state equalization too, right?
yes,
Right?
absolutely. Yeah.
We're
Yeah.
talking about farmers or maybe
Mhm.
businesses that can't be split up very well. Aside from the tax optimization, it's a really great liquidity tool as well for estate equalization.
Right, and for farmers, absolutely, it's a great tool for that, and maybe in Calgary where there's a ton of entrepreneurs, they're all self-made business people. Hey, check it out. I as I do financial plans for people who are about to retire or just retiring, I see a lot of people with corporations that have significant retained earnings in them, and they're just kind of like, I'm not sure what to do with those retained earnings.
Right.
So obviously, we come up with a plan uh, to deal with those, but one of them is, that life insurance is just such a cool benefit in terms of how that works with the capital dividend account. So, um, any other comments you wanted to add for today, Jared?
Well, it depends on your definition of cool, Ken, when you're talking about insurance. For us, it might be cool. Maybe for some other people, it might not be their
Uh,
exact definition.
well,
So,
hey, when the tax bill is less and the payout is more,
yeah,
then it's maybe cool for them.
yeah. There we go. There we
And then
go.
keeping our generational difference between you and I in mind, I guess maybe I shouldn't use cool because in my age, there's probably not too much that's cool.
Hey,
But
I think it's
anyway,
really cool.
I
So
I think it's
I,
really
I'm
cool. So
I'm
it's
in.
just
Yeah.
us insurance nerds. But anyway,
It,
I think it's cool, and the few clients that have done it, that I've worked with and have done it are, once they get their head around it and talk to their clients and the client is involved in the process, they're fully on board. They think, "Ah, this is great." They wish somebody else would have mentioned it to them sooner. So it's just something that is out there. Why not take advantage of it? It's all CRA approved. There's nothing shady about it at all. It's all above board, and a lot of wealthy people are using it. So why not take advantage of that? So, yeah.
exactly. Well
So,
said.
yes. So, okay. Well, Mr. Uncool here and Mr. Cool over there. Thanks again, Jared. I really appreciate it. I kind of give more of the layman's perspective, but it's great having Jared, who's a life insurance specialist as well as an accountant. Having that perspective is really, really valuable because, as you can see in a case like this, that the client's accountant needs to be part of the process, and having Jared being an accountant as well, that really helps with. They're talking to accountant to accountant. They're same language. It's Greek to me, but anyway, they're talking the same language, so that really helps make everything happen. So I'm rambling, so I'm gonna cut it off there. But thanks again, everybody, for watching. Appreciate you joining us. Feel free to subscribe if you're seeing this on YouTube, and look forward to more videos that Jared and I will be doing. Thanks again. Enjoy your day.